Hello folks, welcome to Trend Top. To our old viewer, welcome back to. If you are new, kindly subscribe to channel so you don't miss out on our new videos. When the story of McDonald's is told, it often begins with Ray Kroc, the native Chicago milkshake mixing machine salesman who had the vision to see what the business model deployed by one of his clients, Speedee Service System, could become. This fast food giant may serve billions and billions of customers, but the bulk of their profit isn't made from food sales. McDonald's sells a lot of food. Like, a lot of food. We're talking enough food to serve more than 70 million people every day, with more than 75 burgers sold every second. That shouldn't be too surprising, considering McDonald's is one of the largest fast food chains in the world. But their menu actually isn't what generates the company's multi-billion-dollar profits. The real bestseller? Real estate. There are more than 36,000 McDonald's locations worldwide, but only about 5% of them are company-owned. The rest are franchised out, meaning they're run by individuals who McDonald's has contracted to operate them. In those situations, the company only spends money on the real estate of that location. The franchisee is responsible for all the costs of running the restaurant while also paying McDonald's for rent, which adds up to an average of 10.7% of their sales, a $45,000 franchisee fee, and a monthly service fee equal to 4% of gross sales, Business Insider reports. Why are McDonald's franchises in demand? McDonald's has notoriously strict criteria for its franchisees: net worth, liquidity, etc. Additionally, the franchisees are also responsible for paying salaries, ordering supplies, and paying rent, owning the premises. So, why become a franchisee? The lure is that McDonald's provides them with an almost guaranteed moneymaker due, in large part, to the impressive margins. The restaurant industry is infamous for its turnover, and as any restaurateur will tell you, one major reason for this is that the margins can be thinner than a slice of processed American cheese. Yet, McDonald's operating margins are double quarter-pounder thick, north of 40%. How is that possible in a business whose very purpose is providing inexpensive food? The answer lies in the fact that the food is even cheaper to prepare than one might think. Some menu items, coffee, for instance, sell for dozens of times their cost. Note to people who think nothing of paying $5 for an iced mocha. You're drinking a few pennies worth of beans, boiled in water that's too cheap to measure, and some chocolate syrup. With multiple means of collecting revenue at relatively minimal costs, it's no wonder McDonald's relies so heavily on franchises. We are not basically in the food business, former McDonald's CFO Harry J. Sonneborn reportedly told investors. We are in the real estate business. The only reason we sell 15-cent hamburgers is because they are the greatest producer of revenue from which our tenants can pay us rent. Being able to hand off the costs of running the restaurants is a primary key to McDonald's success. According to Wall Street Survivor, in 2014, the company made $27.4 billion in revenue, with $9.2 billion coming from franchised locations and $18.20 from company-owned locations. But after you factor in the total costs of running those locations, McDonald's kept only 16% of the revenue from locations it owned directly compared to the 82% of the franchise-generated revenue. So while you may spend money at McDonald's on a Big Mac and fries, McDonald's is spending money on prime real estate, and they're loving it. So why are franchisees willing to send so much money McDonald's way? It's because McDonald's brand, powered by its marketing spend, and well-known menu get customers in the door. According to this article, the average McDonald's franchise earns around $2.7 million in annual revenues and around $150,000 in annual profits. So if a franchise owner also earns a salary by working as the store supervisor, he or she can easily clear $200,000 a year. Not bad at all. McDonald's creates the demand for its land. Usually demand for real estate is determined by its location. If it's easily accessible and located close to a lot of high spenders, then the land is perceived to be valuable. This makes traditional landlords reactive. The attractiveness of the land is already predetermined by its location and surroundings, and there is little the landlord can do to affect it without massive and risky investment. McDonald's turns this around on its head. By allowing franchisees to sell McDonald's burgers, fries, shakes, coffee, etc., it creates sales, for its franchisees with which they can pay rent and royalties. If the new location works out, and usually it does because McDonald's has become extremely adept at placing its restaurants, then McDonald's enjoys a recurring stream of revenues from the franchisee. Future plans. As noted in its latest annual report, in 2020, the company continued to evolve to a more heavily franchised business model, and is currently about 93% franchised, with a long-term goal of approximately 95%. The company will continue to make progress toward this long-term goal in 2021 primarily by re-franchising restaurants to conventional licensees. As a result of the continued evolution of the company's business model, in September 2018, the company announced several organizational changes to its global business structure. These changes are designed to continue the company's efforts toward efficiently driving growth as a better McDonald's through the Velocity Growth Plan. The Velocity Growth Plan, introduced in 2017, is McDonald's customer-centric strategy that focuses on the key drivers of the business, namely food, value, and customer experience. Retaining existing customers. Focusing on areas where it already has a strong foothold in the informal eating out, IEO, category, including family occasions and food-led breakfast. Regaining customers who visit less often. Recommitting to areas of historic strength, namely quality, taste, quality, and convenience of its product, food. Converting casual to committed customers. Building stronger relationships with customers so they visit more often, by elevating and leveraging the McCafe coffee brand and enhancing snack and treat offerings. McDonald's remains committed to continuing its aggressive deployment of the 3 growth accelerators, also identified in 2017, in 2019 and beyond. The growth accelerators are: 1. Experience of the future, EOTF, restaurant modernization and technological upgrades to transform the restaurant service experience and enhance customers' perception of the brand. 2. Digital. By evolving the technology platform, McDonald's is expanding choices for how customers order, pay and are served through additional functionality on its global mobile app, self-order kiosks, and technologies that enable conveniences such as table service and curbside pickup. 3. Delivery. In 2018, McDonald's expanded the number of restaurants offering delivery and it is now available in over half of the global system. McDonald's has been, and intends to be, quite proactive in keeping up with the current trends when it comes to expanding its brand and business. In 2017, McDonald's announced it would partner with Uber Eats for home delivery for the first time in the US and followed that up by adding DoorDash and Grubhub this year. These partnerships are part of a strategy to keep up with the newer generations who prefer home delivery over pickup. Key challenges. McDonald's has managed to stay comfortable ahead of its main competitors, like Burger King, Wendy's, Kentucky Fried Chicken, etc., in the fast food arena. But its key challenge might just be a consumer who demands healthier, organic menu choices coupled with fast food convenience. Over the past few years, another restaurant model, one that offers consumers freshly prepared, higher quality food in an informal setting and with efficient counter service, has been making a bid to garner the attention of the consumer, or more appropriately, their palates. Dubbed as fast casual restaurants, these entities, Chipotle, CMG, Shake Shack, among others, have been making inroads into the space long dominated by QSRs like McDonald's. The bottom line. Fast food should be as stable an industry as any. People need to eat and they want their food fresh and fast without having to spend unnecessarily. That said, the industry does face challenges relating to a shift in demand towards healthy eating. A restaurant chain that sells familiarity and consistency needs to recognize that those qualities themselves are enormous assets. Even when McDonald's has an underperforming year, it's still profitable. When operating at its peak, it's a must-have stock in any comprehensive portfolio, especially since it has similarities with rights as well. Thanks for watching. Hope to see you in our next video.